You can pay zero interest on a card and still get punished for one late payment, because Equifax Canada says payment history is the single biggest factor in your credit score. That one missed payment can sit on your report for years and slow everything down. So the way you use the card matters far more than whether you carry a balance, and most newcomers get that backwards. I read the fine print so you don't have to. Here's the uncomfortable truth. Your credit history from back home does not follow you across the border, so you land in Canada with a completely blank file. That means every landlord, phone carrier, and lender is working from zero, and until you build a Canadian record, they see you as an unknown risk. The number that runs this whole game is 30%. Canadian newcomer guidance from banks and credit educators consistently recommends keeping your credit card utilization, how much of your limit you use, below about 30%. Go above that and you signal risk even if you pay the whole thing off later. Here's why getting this wrong costs real money. A weaker score doesn't just look bad. In Canada, it means worse approval. Odds and less favorable rates on your next car loan, line of credit, or mortgage, according to guidance from RBC and Scotiabank. Because the rate penalty depends on the lender and your file, the safest move is simply keeping utilization under 30%, so the score climbs instead of stalling. Take Mina, 29, a warehouse coordinator in Toronto earning $52,000 a year with a $2,000 starter limit. She spends $1,000 a month, which is 50% utilization, well above the commonly recommended 30% target cited by Equifax and RBC. If she drops her card spending to $600 or less, she lands inside the healthier range and her score climbs faster, without spending $1 more overall. Step 1. Apply for a newcomer or secured credit card using your bank's official newcomer credit card page. Scotiabank StartRight and RBC both run programs designed for people with no Canadian history, and this is general information, not a recommendation of any one card, so check the terms yourself. Once approved, open the card details and write down the credit limit and the payment due date, because those two numbers drive everything else. Now make that card work automatically. Set one small recurring charge, a streaming subscription works, and then enroll in autopay for the full statement balance, not the minimum. This does two things at once. It keeps your utilization low and it guarantees a perfect payment history, which Equifax Canada says is the biggest single factor in your score. Step 2. Pull your credit report for free using the consumer access tools from Equifax Canada and TransUnion Canada. Look for your new card, your phone plan, and any rent reporting account and confirm they're actually showing up. If an account is missing or wrongly marked late, dispute it immediately because errors on a thin newcomer file drag your score down hard. Here's the encouraging part. With low utilization and on-time payments, newcomers commonly begin seeing a real score in just 3 to 6 months, according to guidance from banks and credit educators like Neo Financial. That's dramatically faster than waiting years for a long history to just accumulate. But it only works if every payment lands on time. By roughly 12 to 18 months of disciplined behavior, newcomers commonly reach the good range around 660 or higher, per Canadian credit educator guidance. If this is useful, subscribe. The next breakdown is already coming. But before I get to the last move, which is the most counterintuitive piece of this, understand that a single late payment can wipe out months of progress in one shot. Step 3, the counterintuitive one. Adding a second reporting line can speed things up, but only if you pay it perfectly. A postpaid phone plan or a rent reporting product such as Barwell Rent Advantage can build your file faster. This is illustrative, not a recommendation, so check whether the provider actually reports to a bureau before you sign up. Keep the account in your own name, automate the payment, and treat it like the card. 0 misses, ever. The biggest myth I hear from newcomers is that you have to carry a balance and pay interest to build credit. That's false. Canadian guidance from banks and credit educators repeatedly says to use the card, then pay the full statement balance on time. Carrying a balance just costs you interest for no credit score benefit, so you're paying to slow yourself down. Put the two mistakes together and the cost is stark. For someone like Mina, running high utilization and adding a late payment can push the path to a usable score out by roughly 6 to 12 months, based on the common newcomer timeline cited by Canadian banks and credit educators. That delay keeps you paying bigger rental deposits, worse phone terms, and pricier borrowing far longer than you need to. Let's lock it in. Apply for a newcomer or secured card and set autopay for the full balance. Keep your utilization under 30% and check your Equifax and TransUnion files for errors. Then add one extra reporting line only if you can pay it flawlessly, and expect your first score inside 3 to 6 months. Next, I'm covering how to read your Canadian credit report line by line, what every date, balance, and account status actually means so you can spot errors before they cost you. If you want to catch that one, subscribe so you don't miss it. Building the file is only half the job. Protecting it is where most newcomers lose ground.